This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. Welcome to the Wealth Roundup for the week of October 8th, 2025. Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. It's been a strong week last week. Are we looking forward to the same sort of thing with all of the stocks and investments and all of that stuff on the markets this week?
You know, after the U.S. government started their shutdown last week, you're thinking this market could go either way. It could get very bearish on the news. When you kind of hear things like, government shuts down, people getting locked out of work, maybe potential layoffs in the U.S. Those sound like they should be negative indicators, and they still could be. But boy, over the weekend, you saw gold futures go up. You saw Bitcoin hit 125,000 US. So if we start to kind of percolate this through, what might this government shutdown do? Well, one of the interesting things is we didn't get a job report out of the US because that's a federal government office and they're locked out. So no job report. So as kind of institutional money managers are making some decisions, is they don't have that data to say, where are U.S. jobs going? And that was a key piece of data that they're waiting for. So we'll come back to that one in a second. The other thing is that the Fed has to make a decision about rates at the end of this month. And so again, the government shutdown in place, just some kind of concerns about how long that could go on for. It probably increases the probability, if there was any uncertainty about whether or not they were going to cut rates in the U.S., is this probably moves the probability factor up, so you get an insulating rate cut in there just to help out the economy. We did get some private sector data, so some non-government data on jobs, which kind of showed that U.S. job losses are picking up again. So that's something that we knew was happening. And then we get this ISM report, which is a really kind of robust private sector report that talks about the level of manufacturing. Buying managers are going out there and either trying to cut their inventories or trying to build their inventories. And so we got some of that data, which was mixed, is that we still see a lot of spending on anything that has to do with AI. So anything that has to do with AI is getting quite a bit of a bid. Anything else, weak. So that's kind of what we've had over the last, certainly since we did our last podcast.
Here in Canada, indicators are showing that the economy is weak, unemployment is high. Why are Canadian equities doing so well?
That's a great question, because I think there is this disconnect between, you hear that, unemployment at 7.1, yet the TSX is outperforming the U.S. stock market. And you're just like, what's up? Well, part of that is going and looking at where most of the return in the market came from. In the last podcast, we talked about materials, we talked about banks. Well, even though the gold mining portion of the TSX is a relatively small part of the index, the gold miners as a group on the TSX, they're up 40% year to date. And we've kind of talked about some of the reasons why gold prices are up. I think that's certainly one of the things. And then a lot of the kind of the negative data on things like jobs and even GDP, they're not necessarily leading indicators of where the economy is going. The stock market is actually a slightly better leading indicator. And so when we take a look at the market and we say, okay, we got some bad kind of underlying things in regards to the overall health of the economy, but the stock market is doing well, is that we can use the stock market like a little bit of a crystal ball in terms of what to expect in the future for the Canadian economy.
So if there's the stock market at a high level, in that situation, is it good for investors to take some of the gains off the table that they've been achieving?
Another great question. So in the way that we would work with our clients is that we always try to frame some boundaries in regards to what portion of the portfolio we want in say growth, so in equities, and what portion of the portfolio we want is either as a cash wedge or maybe in some fixed income, some more secure investments. So I certainly think over this period of time here is that most investors are probably finding that they're on the high side of their asset allocation, meaning their equities are probably a much larger portion of their portfolio than the cash or fixed income was. And so, yes, I do think that this would be a great time for investors to rebalance those portfolios, realize some gains, take a little bit off the top. Markets have been doing really well. Risky assets have been doing better. And it's always hard to go and sell some winners, but use it in the context of rebalancing that portfolio, kind of back to, where investors are comfortable with their asset allocation. The worst thing that, could happen is that probably you're right. Markets pull back a little bit. You'll feel good that you rebalanced. The second worst thing that could happen is the markets go higher and you think, oh, I could have made more money. To be honest, I think that probably given that choice, most investors would take the latter.
And Warren Buffett, everybody asks Warren Buffett how he got so rich, and he says, I sold too soon.
There we go. Yeah. And he would probably beat himself up about that, but he's done pretty well for himself.
Yeah, I'm not going to start criticizing Warren Buffett on his investment strategies in any way. What other indicators are telling us about the future of the economy here? Have we got any insight there?
Yeah, so we talked about this ISM report. There's a lot of data there. Without the job report out of the US, we use this thing called ADP. Most people receive their paycheck via an automatic deposit. And ADP is the largest check deposit company in the world in terms of processing those checks. And so this ADP report, which is a private sector report, it tells us a lot about how many people are actually getting checks deposited in their bank account from work without having that from the Labor and Statistics Board giving us their data. As we start to look into the private sector for some of that reporting, I think that would certainly be one. And then something else that we referenced a couple of weeks ago when we were talking about the banks was loan provision losses. So as people go and they use credit, how much of those people that are using credit are being sloppy with that credit, and how much is the banks having to set aside for loan losses or late payments. The good thing is in the last set of earnings off the Canadian banks is that most of the banks were able to hold the line, meaning they didn't have to go and increase their loan provision losses. And then the third thing I think that investors should watch, and this is kind of a boring one, but I still kind of talk about a lot, is what's the bond market telling us? And so, where are short-term interest rates going and where are long-term interest rates going? Canadian mortgages are generally based on the 5-year bond rate. U.S. mortgages are usually based on the 10-year bond rate. And so when we see the long side of the yield curve, interest rates going higher, that would tell us that we still need to be concerned about inflation, that inflation is probably not going away. And we know this. This is when we talk about tariffs are inflationary. We've got these tariffs are coming in, and more of these tariffs are starting to get locked in. In the early stages of tariffs, probably everybody was sharing the pain a little bit, just to kind of wait to see how things were going to pan out. Now that these tariffs look like the new reality, and we're seeing more and more trade deals getting done. Carney's off in Washington this week to kind of talk about kind of the early stages of a U.S.-Mexico-Canada trade, probably some tweaking of that deal. So we know these tariffs are getting locked in. Prices are continuing to kind of stay higher. So not surprising that the long end of the bond curve is staying high and maybe moving higher, even though these bank cuts are coming in and they're impacting the short end of the yield curve. So short-term borrowing rates, short-term deposit rates. So these are all things to look at when we're wondering about inflation, interest rates, and just the overall health of the economy.
Good stuff. Lots of interesting tidbits here on this podcast. The Wealth Roundup for the week of October 8th, 2025, with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns.
Thanks, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.